But let's focus on the margins first up. And we have Mr. Natarajan Srinivasan, the MD of CG Power, who joins us. Hi, Mr. Srinivasan. Thanks so much for joining in. Well, this 15% margin, is it an aberration? And what should be the steady state? Because the price cuts, I understand you haven't yet taken, and that could come in the coming months. So what is the steady state of margins that you should be working with? You could give us for the consolidated business or even EBIT margins for both your two segments. Go ahead.
One is margins looks extremely higher when you compare to the margin for the corresponding quarter of previous year. Previous year, probably it was the worst. That was the time when the margins were very low because of the high commodity prices. So therefore, the comparison actually giving some kind of a distorted results. As you rightly said, going forward, some of the cost benefits on account of the material prices will have to be passed on. We are, for this quarter, I think, compared to the previous quarter, the margin increase has been around 4.5 to 4.6%. Maybe I think, probably, while I cannot put a number, at least about 2 percentage point may have to be prepared for over a period of time.
So 13% margins, that's a sustainable number?
So I see, because, still the stability, price stability has to come in commodity prices. They are still been yo-yo is there. And in our case, apart from commodity prices, we have been effecting some procurement efficiencies. We would, we can say that we would try to reach that number, 13.5.
Okay, 13.5%. So this quarter's margins are on the higher side, but that's not the average that you'll see for the full year. Got that. Tell us a little bit about the demand situation, sir, especially at the opportunity from the Indian Railways for electrification, signaling systems, upgrades. Any new orders, and what is the visibility on the order book that CG Power has at the moment?
So actually, we have in the press release, we have given the executed order book as of 30th September. This stands at about 3,600 crores compared to 2,750 crores a year ago. Of which this 1,750 crores is industrial and 1,900 crores is actually the power systems. Inquiries are very strong in power systems. Railways, actually, as I mentioned earlier, generally this is a tender-driven business. They float tenders 1 year in advance. So for the next year, probably the tenders will be decided in the next 2 quarters or before March. I generally feel that the order book continues to be good.
Okay, so what does this mean for your overall growth? I mean, in FY22, of course, you had a low base, but it's a growth of almost 85% that you saw in your earnings. You're sitting on a base of around 5,560 crores. But I guess, that's not comparable because you had COVID as well. But in FY23, what would a sustainable growth rate be on the top line?
So for the 6 months ended, if you see for the half year, I think we have grown the top line by about 36%, and then PBT is about by 91%. So generally, the second half should be better than the first half, or at least definitely will not be lower than the first half. I will leave it like that.
Okay, all right. So for the year, sir, since you've already grown by 35%, should we pencil in something like a 20-25% growth at least? That's one part. And also exports is a very small part of your business. You could correct me on the number, but I think it's only around 10%. Any slowdown you have seen on the export side of business?
So exports were never targeted beyond that because domestic demand is very strong.
Right.
So I mentioned earlier also, we don't want to do exports at the cost of sacrificing market share in domestic market.
Right. And what about growth? Growth,
what the numbers you mentioned can be maintained, definitely.
20-25% for the year, or you want to say 25% since you've already done 35%?
Yeah, sure.
Okay, so I guess the reason why Nigel is also probing is because, you've done some debottlenecking, right, in the motor segment. And that last time around you told us that will add about 10 to 15% to your capacity. Once that debottlenecking gets done, what do you think the incremental or the compounded growth could be over the next couple of years?
So it is possible to grow the overall for the company as a whole, minimum 20% top line for the next 2 to 3 years. To that extent, there is visibility.
Okay.
Okay. All right. Mr. Srinivasan, the other point that the street is looking at is the new production development, new products, whether you're looking at HVDC equipment or higher kV GIC. Could you tell us, as a percentage of your total sales mix, how much is the focus currently on this new business, the new product business, and also going ahead, do you see this scaling up?
So new business actually in the area of motor business, if you look at, whatever we supply, start supplying to EV or whatever we're positioning
Yes.
for the EV segment, that will be entirely new business. It's considering the overall demand that is expected to come from EV as well as the export, plus some of the inquiries from MNCs for sourcing from India because of the China. We have decided to put this capex of about 230 crores for increasing capacity, which will take care of all these new as well as the existing products. It will be difficult for me to quantify in terms of percentage terms because these production facilities will be fungible. So different type of motors can be manufactured, including for the EV segment.
Okay. So this 20% top line growth that you're looking at in the next 2 to 3 years, this is the domestic business, right? I mean, because you said that not too much of it, you don't have a very high growth potential in exports. So I'm guessing this 20% growth is purely domestic?
Partly, substantially domestic, and then, if there are some MNC sourcing, etc., that will be taken as out exports because it will be supplies outside India.